Welcome everyone to the second digital finance seminar on this term. On behalf of myself and my co-organizer, Agostino Caponi, happy to welcome today Markus Brunnermeier. He is the Edwards Sanford Professor of Economics at Princeton University and also the director of the Princeton University Bendheim Center for Finance. And his research focuses on international markets and the macroeconomy with special emphasis on bubbles, liquidity, financial crises, and monetary policy. Today, he's going to tell us about strategic money and credit.
Thanks a lot. It's a pleasure to be here, and thanks for coming and giving me this opportunity. Oops. It's joint work with my colleague, Jonathan Payne. And what is the paper about? We would like to understand how to set up an uncollateralized IOU bills of exchange. It can be tokenized, and you will see what we mean more precisely with that. But there's a lot of, going back in history, a lot of interest. How can you set up some uncollateralized IOUs? And there's essentially long-standing practical challenges. On the one hand, on the financial side, you would like to set up some IOUs where the default probability is very, very low, or is essentially no default, when nevertheless it's uncollateralized. And at the same time, the IOUs should act as money. So they act as a currency, so there should be a good medium of exchange, a unit of account, and a store of value, but here in particular, a medium of exchange. So we want to have the financial aspects to it and the monetary aspects to that. And of course, there is, in the theory, in monetary theory, there is already some framework with this, how to talk about this in a world where it's a frictionless public record-keeping device, a ledger, where all the IOUs can be traded. That's this famous paper by Kochula-Kota, 1998, Money as Memory. And but we would like to set it up in a setting where this is not necessarily only done by the government, but can also be done by a private organization, a profit-maximizing private organization. And in terms of practical solutions, we see this uncollateralized IOU system coming in form of big tech platforms, or trading platforms. And a particular one is Alibaba's MyBank arrangement in China. But Amazon could set up something like this in particular. There's a paper by Lee and Wei Shou, my colleague in Princeton as well, studying empirically and documenting what this platform is doing. So they're saying, there's 98% of the loans provided in this MyBank is uncollateralized. Typically, it's small loans. It's very easy to apply for these loans. You get it very quickly. And people use it mostly for short-term liquidity needs because they're essentially paid back before it's really maturing. They're paid back very, very early on. And it's typically for young first-time borrowers who don't have any big credit history. They use this type of platform. And it's mostly also in rural areas where the traditional banking system is not really working well. And the question is, how can we set up such a system and provide the right incentives to have such a system where, on the one hand, the IOUs serve as a financial instrument to borrow, on the other hand, also as a monetary instrument. And that's what essentially we want to do. So in this paper, we argue that trading platforms are the natural entities to do so, to back such a system. And a platform controls the trading technology, and it is centralized, so we don't have a decentralized token arrangement. It's a centralized ledger. It's a centralized record-keeping device. And the first question is, can the platform set up such a system of uncollateralized IOUs? We say yes, they can do that. The payments through the ledger are automatically used to settle IOUs. So it's a little bit like when you become a small SME, you need a loan. You issue an IOU to this platform. And then you sell your product through this platform as well. And when you get the revenue in, immediately the ledger will net it out. So essentially the thing is paid back right away. So it's also similar to how I'm employed by Princeton University. You get a special mortgage deal from Princeton University when you buy a house. But Princeton takes immediately the cut before in your paycheck is immediately reduced. They take essentially the mortgage repayment, they take it out of your paycheck automatically. This way there's no default risk because immediately the payment is taken out from the revenues in terms of Princeton. It is the case when you have you get your paycheck, it's immediately taken out. The other thing is the platform, of course, has the power to exclude agents from using the ledger and using the platform going forward, and that's the power the essentially platform has. But it can also crowd out some private cash trades, so it can actually, we will show it, we can actually take over the system, and then actually the official cash trading is actually crowded out. The second question is we would like to answer is, will platforms set up such a system or not? When will they set it up? We would say maybe. And they will typically set it up only if they have a large enough control of the ecosystem, a large enough fraction of trades in the economy are done through the platform. Okay. And the question is also, is this the only way to set it up? Are there other arrangements? We argue and we show that if you have a standalone ledger, somebody who records all the payments, like Ethereum, they cannot incentivize this the same way as a trading platform can do. Of course, banks can also do a lot of lending, and the banks can exclude you from future borrowing, essentially. And we don't have this dynamic setting in our setting. So it's not the case that you have to borrow something, then you pay back because you know in the future you might have to borrow again, and so forth. So that's not what's going on in our model. And we will also argue that an industry supply chain cannot do the same thing as a broad platform can do that. Are there some policy issues? Of course, there are policy issues as well. The platform can extract rents because it has quite some market power, and there's a balancing act. How much rent do you want to give the platform? Some rent to set up this credit system, the system of IOUs, but you don't want to give it too much rents. And there's also an issue which will come to it later on. If you make the public ledger so very powerful and very attractive, then actually the platform will go and become a black market. So you can default on the public ledger and then you can do your payments on the private platform or ledger. So there's a literature that touches on different literatures. So one is the literature on ledgers and contracting and settlement asset. That's where this Kocha paper falls in, or Agari, Wallace. The big difference of our framework is that it's actually a private entity setting this up. It's not the government setting this up. It's a private profit maximizing institution who controls the ledger where all the payments are recorded. And of course, it relates to the big tech uncollateralized finance. So in many emerging economies, you don't have all this collateral you can pledge. So you need some uncollateralized finance, and to some extent, the big tech companies can step in. And I mentioned already the example in China. There's, of course, other examples in India and so forth. And then it touches also on digital currencies and currency competition, because, of course, there will be a private currency competing with the official currency from the government as well. So essentially, overall, what we bring here together, we have this monetary theory on the one hand, but we combine it with industrial organization because it's not provided by the government, it's by a profit maximizing entity setting up the system of IOUs, which acts as money in our setting. So the way I would like to proceed, by the way, you can ask questions anytime. The way I would like to proceed is to set up a very simple two-period model to illustrate the main points. But I will make some simplifying assumptions to keep it as a two-period model. And then I will set up full monetary macroeconomic models. And first the model itself, and then I will talk about the extensions before then concludes. Okay. So the environment is the following, very simple. There are two types of agents. There are lenders and producers. The lenders have a certain good. They give it to the producers. The producers, at time zero, they can make something out of it. Okay, so here's so two types of agents, lenders and producers. There are two types of goods, a storable input good and a perishable output good. And so the lenders are endowed with the input good. They can actually then give it to the producer, and the producer can then start a project, produce something, which then, from one good, it creates Z or Z output goods. And then people consume at period one. Okay? So the producer must So the producer doesn't have anything initially, so he must issue an IOU in order to buy this good and this input good in order to make an output good or make Z output goods. And we also assume the agents, they cannot consume their own thing, they have to trade the asset. Okay? So there's some need for trading, and that's why you want to be on the trading platform, essentially. Now, the first thing we can do is, okay, so let's first understand what would be the first best arrangement if there were no major financial frictions. So the first best arrangement would be that the input goods from the lenders, they are given to the producers and they can start the projects, and then all the good producers produce some output goods, and across the agents they trade and consume them subsequently. Okay, that's in a very simple frictionless world. The frictions we assume here, so all agents have their public identities, but you know the actions are private, so you cannot monitor, you don't see their actions. In particular, they can default on things and can do some private things. The agents cannot commit, and there's no public legal system, or there's an imperfect system only for contract enforcement. So the big thing is there's no legal system where you can enforce all the contracts and sue and go after some borrowers who didn't pay back. So in such a system, essentially, producers cannot issue IOUs privately to lenders because they will not be repaid. And the question is, can we introduce a privately controlled record-keeping system, a ledger, and get IOUs issuance going and get closer to the first best production in a market economy? Okay? There's no government. There's essentially think of an emerging economy where the court system is not functioning well in order to do that. So the way I would like to proceed is I first look at two market economies. There's an economy first where it's an independently, privately operated ledger. There's just an entity which just says, okay, I provide a ledger to the economy. And then I say, okay, now I would like to have an economy where the tech platform, which also arranges the trading in the period one, and controls the ledger as well. So first, it's totally only a ledger operator. Has nothing to do with the trading platform. And the second step, it will be then the trading platform is the ledger operator as well. Okay.
Are you describing a system that exists in some way, or are you proposing it, or you suggest one would emerge given today's technology?
No, here that's an abstract thing. So what I will argue is that if you have an independent ledger operator, it will not work. Okay. So you really need a merger between an entity which operates the trading platform and the ledger.
But why am I asking the question? Is this something that exists, or is this something that is...
It exists. So like if you go, it's like China's Alibaba essentially is a trading platform at the same, and it has a banking arm, the My Bank, which essentially provides the lending operation.
So you're trying to describe the economics of Alibaba?
Yes, you can view it this way. Yes, so Alibaba is one example. I would argue you could actually expand this in many emerging economies. You can go to Africa, so big trading platforms. If you set up trading platforms, you could actually provide some loan provisioning to a lot of small and medium enterprises if you want to. Okay, you can put the Alibaba model essentially also to many other emerging economies. Of course, you might argue for countries where there's a perfect court system, you might not need it, no, because the perfect court system. But if you have countries, emerging economies, where the court system does not work so well, then this might be an alternative way to do it.
So you were saying the reason the tech platform controlling the ledger is good is because they're going to control access. In other words, if you default, you no longer have access.
Yes.
Why isn't that the case for the privately operated?
No, both of them privately operated.
But why does the tech platform control work and the independent privately operated not?
I will show you. That's that's what I want to.
So how is this different from the old traditional banks that lent you money and all your checks had to be deposited in the banks when you sold something, and the banks then allocated that money?
It's very similar to that.
Okay, so this has existed.
So essentially what we allow...
For years.
So we in the model itself, we allow for cash side trades. No? Okay. So the bank cannot enforce But once you have this trading platform, you have to trade, you sell your items through the Alibaba ecosystem now.
But also don't forget the bank's loans were all demand loans. So if they caught you doing that,
You can
the
exclude it.
demand repayment on any fixed assets you have.
Yeah, I don't know, I have to look up this thing. So when was this done like this?
Oh, years in small towns in America all the time.
But in the last century, in the 19th century?
And
or-
this is there's a very old literature that the reason banks are so good at lending is that they can control repayment. And that's why the real bills doctrine was always the
Yes.
control of the goods.
But couldn't you just, because there were no dollar bills, you couldn't make some side payments with dollars?
I mean, you could, but again,
If they catch you.
you know, they're entitled to the goods until they were sold, and then they had to be sold for a check to the bank.
Yes.
But I think it's the control of transactions as well as the record of transactions
Makes sense.
that matters.
That's one other.
Oh, sorry.
No, sorry, just one other clarification question. The IOUs in the model in the Chinese example, do they also circulate as money or as just a loan?
So the IOUs, so you're a small or medium enterprise, let's say, you have nothing, you just have to issue an IOU, and this IOU essentially then circulates as money, okay? But it's managed, in this case, by Alibaba ecosystem.
In their accounting system.
As their accounting system. So they manage the whole ledger arrangement, who owes what, how much, and all these things. And when the payment's happening and all this.
Your argument sounds a lot to me like the sovereign debt literature. So Bulow and Rogoff say if you can't enforce repayment, you usually can't against a sovereign, then nobody will repay their foreign debt. And then the others came along and said, yes, but you could exclude the country from international trade because that trade is usually run through foreign banks, often here in New York. And if you can do that, then you can enforce debt repayments. And that sounds technically, I mean, obviously the context is quite different, but like what you're describing.
Yes. So who was arguing against Bulow and Rogoff?
I forget. I'd have to go look up the paper. It's been many years, but I can.
It would be yes. There's some similarity there. So I'm not familiar. I know Bulow Rogoff, but not
The exclusion from trade exception.
Okay, great. So let me first do that. Let's suppose the ledger operator is just an entity profit maximizing on its own and is not controlling the tech platform where then the trades are happening. So we have an independently, privately operated ledger that records and executes trades and contracts. There are two payments. So you can have a spot payment at time one. They're not recorded and are settled immediately with input goods. So essentially what you do is I can just buy something with the input good. I never lend it to somebody to produce something. I just keep my input good and then I just buy something with it. And that's a spot payment. It's not recorded anywhere. Of course, you have to hold the input good in advance. And then there's a centralized payment on a ledger, L, and it can pay with the IOUs to certain future, with certain future revenues. So the producer can issue the IOU on the ledger. He promises capital R, that's a gross interest rate. So capital R goods at time t equals 1. So he borrows at time t equals 0 for each input good given at time t equals 0. And then the ledger automatically uses the revenue from the trades and settles the contracts. But the revenue from the spot trades cannot be used. Okay. So if I put it here in this picture again, so as I said at time 0, the lenders are endowed with some input goods. The producer says, I give you an IOU, you give me the input good, and then the producer can say, I produce something, then I get some output good, or the producer can say, I just take the input good and sit on it and store it, okay? Because I intend essentially to default on it anyway, okay? And then an agent meets randomly and swaps the good. If it's on the spot market, the goods are exchanged, and if it's on the ledger, the goods are paid on the ledger, and so the ledgers are then settled and consumption occurs, okay? So essentially, if I'm a producer at time 0, I can make a decision to say, okay, I can use this input good, produce an output good, sell it on the spot market, on the ledger market. Everything will be automatically settled. I made out of this one input good a Z, more than one output goods, everything will be settled. Or the producer can also say, I just keep this input good. I will do my spot payment, and then I can default essentially on the IOU and never pay it back. Okay? And I just use this input good which I just stored. I cannot consume this one directly. I still have to exchange it with somebody else for a different output good which I can then consume, and the other party can then consume this input good I have stored. But I never intended at all to produce something with it, and I never intended to pay back the IOU. Okay, you default with that. So the result is in this setting, if there's only a ledger operator who doesn't have any platform control, in equilibrium there will be no agent will accept IOUs, and there will never any production taking place. Okay? So let's think about it. If other agents are producing, so let's suppose all the other agents will produce, then it's optimal for an agent to store this input good, purchase the output good, use the unrecorded spot trade, and default. Okay? So you don't have any incentive to say, okay, I would like to produce something as well, and then trade on this platform, or on this official ledger, where immediately I have to pay back my debt. What I rather do, I just keep the input good. The input good is then used like a cash good, and then I pay with the input good, and then I never pay back my IOU. So relative to Coach Lakota is that in this environment where the ledger is privately operated, this competition to this, I have this alternative spot payment system, so this competition next to the ledger destroys essentially this privately provided ledger. So introducing an independent, unbacked common ledger does not really expand the contracting space. Now what I want to do next is that let me now introduce a trading platform offering this ledger and show you how they can actually then increase the contracting space, and then some IOUs can be issued, and these IOUs can then also be used as money. Okay, so it's the same environment as before, but with trading frictions. There are now two trading technologies for connecting goods traders. There's an open public marketplace, O, and then there's this private platform, P. It's a private profit maximizing operator. And agents defined platform trades with probability eta. So with probability eta, you find a counterparty said, from the platform, on the platform, probability 1 minus eta, you find somebody on the open public marketplace. Okay, that's, in this part of the paper, it's just exogenously given. So you have something, said, you bump into somebody on the platform, or you don't bump into somebody in the platform, you bump into somebody on the open public marketplace. And the platform provides a trading technology and also this settlement ledger. And it forces agents who want to trade on the platform to make payments using their ledger. So if you want to trade on the platform, you have to use the ledger provided by the platform. Okay? And the platform is also charging a markup. If you want to trade on the platform, it will charge also a markup mu when agents want to trade on this platform. So here is the situation now. As before, time zeros, the lenders are endowed with the input good, they give it to producers, and now you use the input goods to produce output, or you store it, the input good, and then plan you will default later on. Now in time one, with probability eta, you find somebody on the platform who wants to trade with you and use the ledger. So the ledger takes the resources to settle the IOU, and the producer, he gets essentially 1 minus mu z minus r. So he takes one input good that gives z output goods, r he promised, that's a cross interest rate, he promised to the lender, so that's what he gets in net. But of course he also has to pay a markup, so that's 1 minus mu, that's where the markup goes away. That's what he gets from this interaction. And the buyers with the input goods, they get a 0. So if a buyer comes along and they said, I kept the cash input good, And now with the cash input good, I want to buy something on a platform. He'd accidentally bumped into somebody on a platform. The platform says, if you want to come and you store the input good, you want it to default, I give you essentially, you get a zero. The markup will be so high that the buyer gets a zero payoff. Okay. Now, if you accidentally bump into somebody who is off the platform, so on the public marketplace, then it's with probability 1 minus eta. So if finds producing buyer, can't barter, uses the ledger and repays the IOU. If finds a buyer with an input good, then the spot trade happens and he can default. Okay? And then ledger settlement occurs at the end. So essentially what we want to have a setting where people say, actually at time 0, actually I would like to produce. So I have an incentive constraint where I say, okay, I always would like to produce rather than store the input good, hoping I bump into somebody off the platform and then subsequently you can default on that. Okay? So the incentive constraint is the following. So the question is, it should be the storing the input good should be less attractive to me than using the input good to produce something. Okay? And here's just the formula what I have shown you earlier. So if I store the input good, with probability eta, I bump into somebody who is in the platform, and then the platform set the markup so high, said, oh, you want to default on it, they just charge a huge markup, so there's no payment left for the guy who wanted to default. If you store input good, you meet accidentally somebody from off the platform, so from on the spot market, but then actually you get the full 1 unit you have stored, and that's the payoff in expectations what you get. Now if you think of producing something, so use the input good to produce something, again, with probability eta, you get bump into somebody who is on the platform, that's the payoff I described beforehand. With probability 1 minus eta, you bump into somebody off the platform, and then you get essentially this payment. You can default with this thing, but with probability 0, when you default, you would get this, but with probability 0, you will actually bump into somebody because everybody is producing on that. So that's only the expected payoff you get from that. Now, what you can see from this incentive constraint, if eta is sufficiently high, then this thing becomes sufficiently low and this thing becomes sufficiently large, then actually it's much easier to satisfy this incentive constraint. Okay, so if a lot of people always are on the platform, and hence it's more likely that a bump into somebody who is also on the platform, for this part of the paper, this eta is exogenous, then actually it is the case that this constraint is much easier to satisfy. If eta is low, then this incentive constraint might not be satisfied. Okay? So, or put it differently, if eta is sufficiently high, exogenously given, then or put it only a dominant trading platform is setting up this, then incentive constraint is satisfied, everybody will produce, everybody will borrow, will issue IOUs, and also intends to pay back the IOUs. So the borrow, the issue, IOUs, and actually everything will be first best efficient. If eta is low, this exogenous parameter, then actually you can't, the incentive constraint is not satisfied. So in this sense, it is the case that, whenever eta is high enough, if sufficiently a lot of trading is flowing through the trading platform, you can actually sustain this IOU arrangement and everything is getting towards the first best. And there will be also no default, so that's why the competitive gross interest rate is 1. Okay, that's all the R's you can set equals to 1. So what are the lessons so far? By comparing this market economy 1 with 2, ledgers are only useful if they are backed, so private ledgers, and if they're backed by some trading platform. The second lesson is that the payment technology can collateralize sales revenue. So even though there's no collateral there, so it's an uncollateralized economy, we don't really need some collateral like in Kiyotaki-Kimura and other models. You don't need this collateral because essentially there's digital collateral through the payment and the trading platform. And The big problem is essentially, unlike in Lakota, is that you always have this side trading possibility because you can deviate from that. If you have only one official ledger and there's no way you can get around from that, then the public ledger would work. But if you have a private ledger and at the side you also have an alternative option, a cash, or you just store this good, then there's some crowding out. And this, you have to control this incentive constraint that. Now, of course, there is a natural monopoly, essentially. If you have a platform which controls a large fraction of all the trading activities, like this Ether, it's much easier to incentivize the IOU repayment to default.
So can we say that this is a loan that is collateralized by access to the platform, and your ETA is just showing how valuable the access to the platform is?
You can say that, yes. So in a sense, you get access to the platform, and the platform can exclude you, and that's how much you value that.
If there is only one way to transact, like then you just it's full of.
That's correct. So if eta is 1, then it can only, so we will endogenize the eta in a minute, but in general, if eta is very high, it's very likely that it can only interact with somebody on the platform, then it can't actually not do anything. And then, that's the only option you have, and that makes it costly, and that's why you would like to be part of this ecosystem. But in a sense, if eta is very high, there's a natural monopoly in a sense. The total surplus essentially is in this economy z minus 1. And the higher eta is, the easier the incentive constraint is to be satisfied. So the information rent I have to give to the agent is actually much smaller. So the higher eta is, the smaller the information rent, the smaller fraction of this total surplus I have to give to the agent, and the rest of it, the surplus, can be extracted by the platform. Okay. And you might say, oh, they extract potentially too much of the rent. Okay. So let me perhaps jump to the full model now. So what I want to do now is I would like to generalize the model to make a full monetary model. So I didn't have any money so far in a sense. I had this cash input good. The input good I could just store and use as a payment for buying another good coming. So it was just essentially I was using a good to pay for something. Now I would like to introduce some real money. So the question is, if I want to change the environment to some extent, what are the macro implications of using the platform-backed IOUs as a currency? So I want to change the model in many different ways, or generalize the model. So they introduce the settlement using a currency, so a government cash, think of dollars, in the spot market. That's a little bit like what Bruce said. Not only banknotes, I can also use dollar notes. And the spot market and IOUs on the ledger. So we introduced the secondary market for IOUs in endogenous terms of trade. Now we actually set up an infinite horizon model as an OLG model, because in order to have currencies valued, you have to have an infinite horizon model, because essentially this, from the service flow this money gives you. And we want to discuss some dynamic feedbacks. We allow the agents now to choose where to trade. So far it was the case, some agents were just trading. When you bump into somebody who trades off the platform or on the platform, that was an exogenous choice, or that was just given by nature. And now it's an endogenous choice. So this ether will become endogenous. Depends how high the markup is on the platform, makes the platform less attractive, then it moves away. We also introduced some financial intermediaries in form of funds. That helps us to get the aggregation going in the financial markets. And we also introduced a flexible project size. So far, the project size was just one input good and Z output goods. Now they can scale it up and down. It's a concave function. Okay. So that's the changes we want to make, just to give you the main settings. So now it's discrete time as before. It's an infinite horizon model. It's overlapping generations with only one consumption good. Okay. Now, agents live for 3 periods. So agents start as producers and then become log utility consumers. So now they have log utility. So agents are born without any resources. They're totally poor, but they have an idea. They have a technology. They convert X input goods or goods. So now we don't distinguish input and output goods, just goods, into some, in next periods, output goods, and that's the production function. So alpha is smaller than 1, so it's a concave production function with productivity of Z. Okay. So at time, when one period goes by, your age increases, so you've produced some of this, so some of the production you sell, you issue, here you borrow and issue some IOUs, then you produce and sell the goods, you consume some of the goods, not your own, you have to buy it from somebody else, you repay your IOUs or default on the IOU, and you save because you also want to consume and still in age 2, okay? So essentially now you're born without anything, you borrow, you issue IOUs, you get an input good or get some goods, with that you produce something with a concave production function. At age 1 you have all the output, but then you want to trade to get some consumption going. You might default on the IOUs or pay back your IOUs, but you also want to save because you still want to consume in period when you're at age 2, okay? So that's why we need these 3 periods here. So at each age, you choose essentially which trading technology you want to be on. Do you want to be in the open marketplace or do you want to be on the private platform? Okay. So the way we do that is you get some IID, extreme value search amenity shocks. Okay. So that's you get the zeta shocks depending for each the 2 marketplaces or trading spots. And that's a gamble distribution with 1 over gamma. And gamma is essentially the elasticity of substitution at the age of tau. Okay? And then you get the technology-specific component as well. That depends how much more efficient it is to be trading on the platform relative on the public market space. So it might be just much better to be on the private platform.
Given that there's this probability that you might bump into somebody in each of these trading domains,
yes.
do you want to do a little bit of each?
No, but that's a discrete choice. You have to make a choice.
You're imposing that.
Or
Or you're
yes.
saying that's optimal.
So given the setup, it's the optimal thing to do.
Why?
So let me think.
Just because my thinking was because there's a probability you might meet somebody on the platform and there's a probability you might meet somebody on the open market, you'd want to be in both places.
Yeah, we assume essentially that you can only but the shock you get, yeah. Yeah, we'll see that. It's essentially, it comes only, you get the shock and said, okay, where should I trade? You get the shock, okay, I get really an amenity shock. It's much better for me to be on the public market. Yeah, you cannot trade on both things. So we assume this discrete choice, essentially.
A quick question. Why do you have consumption both in the stage 1 and stage 2? Could you say state in period 1 and just produce and sell, or a repay or a default, and then
you could do this too. Yeah, so essentially what we wanted a setting where you first you're a borrower, and then from 1 to 2 you're a saver. From 0 to 1 you want to borrow, so issue IOUs, and then from age 1 to age 2 you save, essentially, because you produce something, have something, and you don't want to consume everything right away, you want to split it. But you can actually, so we will see you can change the parameters. You can say, okay, I don't want to consume it all at time 1. That's fine too. That's just, yeah. I will see you change the discount factor and say you get, much more higher, utility from consuming at time 2, and then it would work the same way. So we don't really need that, yes. So here's the timeline again. So here's the generation T, let's say. They are born. They want to get some input goods, so they buy this from the previous generation, which just have produced some goods, And so they buy it from them. And then they produce when they're young, so at time when the age of 0, that's the output. And then they consume some of it they pay back, so then the old generation can consume from that. And some of it they save, which the new generation, T+1 generation, is issuing IOUs. And then, then they will produce something, and then you can consume when you're old. Okay. Or in age 2. Okay. So in terms of currencies, so there's now 2 payment technologies. Now you can settle financial games. There's a spot transactions, has a resource in advance constraint. So payments must be made using public money or barter, let's say some dollars, okay, dollar bills. Or there's this digital ledger, has no resource in advance constraint, and the agents pay on the ledger using IOUs claims to a non-risky future income on the ledger, as I mentioned before. This is the ledger IOUs or credit goods or digital bills of exchange. There are certain prices, so the goods traded on the platform, that's our numeria. So the price, that's the price of 1. And then there's an exchange rate, there's a real exchange rate between the IOUs money and this money. And then there's also, of course, when you have the return on the IOUs, that's RB, and that's the return on money as well. So what's the return you get on this in real return? And there's a continuum of competitive mutual funds that pool the resources across the agents, and they issue deposits at the interest rate of RD. They make the loans at the interest rates of RL. So these are financial intermediaries, and they hold the money reserves and also hold the platform equity. So somebody owns the platform as well. So that's also owned by the citizens in this economy. And what the funds do, they exclude defaulting agents. So if an agent is defaulting, the funds will exclude them. Okay. And the funds accepting default. So if an agent defaults and says, okay, I default on it, now I have a lot of money, I would like to store it and save it somewhere, and a fund were to accept such an agent, the ledger operator would would actually exclude these banks or these funds. Okay? So in this sense, you can also bring it a little bit to the international context. The Fed system or the SWIFT system could exclude banks which accept defaulting agents. Okay? So there's some analogy there too. So as I mentioned already earlier, so you have essentially when you want input goods, you issue IOUs, and then you pay back your IOUs. Perhaps I should jump in a minute. That's typically these funds. The funds, they actually have this cash. They have the IOUs, and there's the platform shares. That's the asset side of the funds, and they issue these deposits. And so first, and it always goes through the funds. And when you pay back, essentially you pay back what the cash you get, the IOUs you get, and you have the claims here, and then you get the deposit. So in each round, it works this way. So each generation chooses then, each generation T chooses at each point in time how many input goods or how many goods to purchase, X0, how much to consume at time 1 and time 2, and how many deposits to take. So this problem is quite involved. So here you can see if I make this beta equals to 1, then you don't want to consume it all the time at age 1. And then there would be just a 1 here. So this depends just what beta you choose here. But there's all these amenity shocks. These are just to get this discrete choice going, to get a shock and say, I enjoy more to be on this platform relative to not being on the private platform. And then you get consumption utility at time 1, and get consumption utility at time 2, and you also get this amenity shock here. So the deposits is, if you look at this, that's what the output is at time 1. That's what you have to pay to the platform and pay back. So the platform charges a markup. You have to pay back your loan as well. And that the rest you can actually then save in form of deposits. And that's the budget constraint when you're at age 2. So again, these zetas here, these are all extreme value shocks to get this discrete choice that you want to go on one or the other place. The mu's, that was the markup charged by the platform, and this epsilon is the exchange rate, because the price will be different whether you're on the platform or off the platform. Now I won't go into that. So all of these etas now are endogenous, but they all turn out to be in closed form. So it might be, these are complicated, looks like complicated expressions, but they're all in closed form. Even though this program is quite involved, everything is in closed form, and also the exchange rate is also in closed form. But rather than going through the formulas, let me show you some numerical illustration. So what we do here is that, so let's on the x-axis, I always have the markup the platform is charging, okay? So, and let's focus first on the blue dashed line. That's in a world where the interest rate were to be fixed. So we have a partial equilibrium, think of a small open economy, where the interest rate is fixed, is not moving itself, is not endogenously determined in the system. Then you can see if the platform charges higher markups, the activity, a fraction of people going to the platform is actually, as the markup goes up, it goes down how many want to be, and it always goes down. The higher the markup, there will be the age of 0 guys want to not be on the platform, and the fewer guys want to be on age 1, and so forth, is always going down. And the exchange rate is roughly flat, and the total output is given by this expression. Now if I make now the lending market, the interest rate endogenous, so it's not given exogenously, it also moves. There's this interesting phenomena. The higher the markup is for the platform charges for trading activities, the higher the interest rate is. Do you have any hint why that's the case? Otherwise, I tell you. The reason essentially is that if the platform charges a higher markup, people don't want to go so much to the platform. They want to trade off the platform. But if you trade off the platform, you don't use IOUs of the platform of this platform ledger. Okay? And the IOUs, essentially through the IOUs, you create essentially demand for these IOUs, and the IOUs essentially bring, so the fewer people use the platform, the higher then the interest rate will be. Let me show so. So if the platform charges a higher markup, it encourages agents to trade on the public marketplace, not on the platform. So there will be more demand for cash. Let me just finish this. And so there will be more demand for cash, but there will be less loan supply, and that leads to higher interest rate. Okay? Because if people use the IOUs, there will be more loan supply. This would be a lower interest rate. But if they all use the cash, they store their wealth in cash, so nobody can actually provide the loans. Okay? So there's less loan supply, and this leads to higher interest rate. Okay? And that's essentially what's going on. So what you see in the full model is, and if we close the whole model, the more the people get away from the platform, because the platform charges a higher markup. With the high markup, the platform is not so attractive. We get away from this IOU system as a financial instrument. There's less loan supply. And then, of course, people still want to borrow in order to produce something. And that's essentially leads to a much higher interest rate. Now, what it also, in general equilibrium, of course, what also happens, the opportunity cost of holding cash is going up, okay? Because you said, oh, I could have gone to this. And that partially offsets this markup disincentive to trade through the platform. Okay, that's the first order effect. And then, of course, the opportunity cost of holding cash is going up because I could have earned this high interest rate by going on the platform and using this IOU as a store of value rather than the cash. Then this actually offsets then this effect here. So it becomes a little bit smaller, but it's still a large effect in this numerical example.
So going back to your previous slide, so you said that if the markup goes up, then it discourages naturally people from trading on the platform. But then your etas are going up. Your eta 1 is going up, which are the way.
In the black one, yes.
Yeah, the black one. So it means that there are more people trading on the platform. Or am I
That's correct, yes, but this comes only if the interest rate is endogenous. It comes through the interest rate effects. So this actually overturns, that's right. So typically, if the interest rate were a constant, you'd always would go down. But because of this interest rate effect, there will actually more people ending up at age 1, not in these other ages. There's a peak here and then it goes down. But at age 1, it is the case that there end up more people at age 1. So I have to think about why that's the case. Yeah, because the interest rate will be so high, so you want to store your wealth. You have a high incentive because of the high interest rate to say, I would like to have more of my wealth stored in IOUs rather than in cash.
So can you explain again why is it that the interest rate goes up because there's less activity on the platform if there's more people on the platform?
So essentially, when you're at age 1 to age 2, you're saving, you want to save. When you're from age 0 to age 1, you want to borrow. Okay, so if the platform, if the platform is charging higher markups more generally, then it will be the case that you say, okay, I don't want to, the markups are so high, I don't really want to go to this platform anymore. Okay, so there will be, it's much less attractive. But then it's the case if the interest rate is very high, there's also the other force with high interest rate, say, okay, what's the opportunity cost? So I can either store it in cash, I get no interest on it, or I can store it in the platform, then I get a much higher interest rate. And that's why people are coming back to some extent. Okay, so essentially what I did here, so I should have said, this is under the assumption there's no default. I ignored the incentive constraint. I just assumed everybody is just playing according to the rules. They borrow with IOUs or not with IOUs, but they just do this and there's no default in this setting. Now, of course, I still have to check the incentive constraint. What happens, is this incentive constraint satisfied or not? Okay. So there's the incentive constraint, so the platform excludes agents who default from the ledger and the trading platform. So essentially the incentive constraint now is the agent's profit at age 1 if you default. So at age 1 you could actually default. This would be a good thing. So you would like to default times what is the marginal value effect at age 2 if you exclude it from the platform. So this is, you get the default from defaulting at age 1. You have to say what is the times the marginal value from the value function of the wealth at age 2 if you exclude it, has to be smaller than, so in order not to default, if you repay times what's the marginal value if you have access to the platform. So on the one you default, but then you exclude it, and here you repay and you have access to the platform. And that's the constraint, incentive constraint we have to satisfy in order to make the whole system working. Now what we do is essentially the platform's problem is to say, okay, it takes the households SDF as given because the platform is essentially held by these households. That's the SDF here. And these are the profits of the platform, all future profits, and that's the value of this. And the platform is maximizing this future discounted with SDF discounted profits given the agent choices and equilibrium prices. And that's what the platform maximizes, subject to the incentive constraint. And let me just illustrate that how you can vary that. So I should recall you this gamma 2 was essentially the elasticity of substitution between the two trading arrangements. So remember we had this discrete choice, we had this extreme value, this Gumbel distribution, and gamma was the elasticity of substitution. If gamma 2 is very high, the forces which hold you in one or the other one are very weak. If gamma 2 is very low, then you can easily switch from one to the other one. They are perfect substitutes. Okay? So this gamma 2 is the elasticity of substitution. So the question is how much can the platform, the markup the platform is setting if I change the elasticity of substitution and move it up. So typically if there's no incentive constraint, this would be this blue line extended by the dashed line. If I take the incentive constraint into account, The incentive constraint is essentially given by this red line. So essentially overall, to make sure the incentive constraint is guaranteed, the markup is set by here where the incentive constraint does not bind, and then the incentive constraint is binding. So the higher the elasticity of substitution, this exogenous parameter is, the lower the markup is. And then it drops off. Once it starts binding, it drops off significantly. And that's also, you see, that's the exchange rate across the price of the platform relative to off the platform. It also gets a kink here. You can see what the fraction of agents in this economy. You can see that, they first go down as the elastic substitution goes up, and then you have essentially this kink coming when there's this incentive constraint is binding, then it goes this way. And then similarly for different ethers. But the important thing is the value function of the platform. So if your elastic substitution is fairly low, then the value of the platform is positive, and at some point it drops off, and if the elasticity of substitution is very high, then it is the case that it becomes actually negative at some point. Okay. So the elastic substitution being very high, this means it's very competitive. So you have a lower markup, and the markup is dropping off significantly from this point, and the value of doing this whole scheme might be negative for the platform. Then the platform doesn't want to set up the scheme anymore. Okay. So as long as the value function is positive, the platform is setting up the scheme, nobody will default, and everything is working hunky-dory. But if the elasticity of substitution is sufficiently high, they will not set up the value of the platform. Now let me talk about the few extensions, and I know that I'm running over time. Let me say, I just give you the flavor of that. So the first one is, so far we have assumed in the old G model that the platform or ledger operator only allows IOU payments on the platform, okay, and excludes agents from platforms once they're default, okay. An alternative setup would have been that the platform ledger operator has more control. He allows IOUs to compete with cash on the public marketplace. So you can also use the IOU payments if you're off the platform, okay. But it still prevents using cash on the platform. But you can use IOUs on both trading arrangements. And it also prevents IOUs to be exchanged for cash, okay. In such a world, actually, you can have what we call this tokenization. It's a different meaning of tokenization. It's like dollarization, where the tokens or the IOUs take over and crowd out the dollar, essentially. Okay. So if the platform says, okay, I allow IOUs to use these IOUs on the platform and only off the platform, there's no exchange. You can come with your cash. I don't give you anything for this cash. And then essentially the platform can actually crowd out totally the dollar and take over as a world currency. Now you could also say, let's have a different setup where the government tries to set up a ledger which is a smart ledger, a smart CBDC in a sense, where this ledger can be connected to everything on the public marketplace and the platform. Okay. So now in this setting, the government is really legally obliging. It's a forced tender ledger. Everything has to be done through the government ledger. Okay. And then all contracts are enforced. And what happens in such a same framework, essentially, then the platform, which always has the incentive to enforce the IC constraints so that agents don't default. That's what the platform in the previous setting always tries to do in order to get this whole IOU system going. But now I have this government CBDC arrangement, and actually the whole thing flips now. Now actually the platform is providing a ledger payment, which is like a Bitcoin ledger where you can actually, it focuses on people who default, and they can make payments on the platform then. Okay? So it flips around. So rather than being the good boy trying to enforce repayment of the IOUs or make the IOUs going, then now they're focused on the alternative. Say, okay, the government is trying to enforce that, but it becomes like a platform which promotes use, which are then some hidden tokens where you can, is it like a black market or a Bitcoin market where you can actually attract the people who are defaulted beforehand. Now finally, just 1/2 minute, we have always the competition between, we had the private platform or the government cash. Okay, these are two competing. We could also say, okay, let's ignore cash, let's have two private platforms competing with each other. Okay? There's no open marketplace. There are two platforms, platform 1 and platform 2, and both of them charge a markup. Okay? And everything happens simultaneously. And then the question is, all transactions are observed by one of the two platforms, and the question is, how will it then play out? And then the regulator can allow some Nash bargaining at time 0 in the beginning over committing to exclude certain banks and funds. If there's default, do I exclude the other party or not? And what we see in such a setting, so I'll just give you the results, the outcome of the bargaining at 0 is that if both of these private platforms and ledgers are equally efficient, so the amenity you get from them, the zeta is the same, the contracts are enforced on both ledgers, and there's no transfers between the ledgers. On the other hand, if the zeta 1, the amenity shock of the platform 1, is way larger than the amenity shock of platform 2, then the platform 1 will provide a monopoly ledger, and the platform 2 essentially pays a fee to the platform 1 in order to operate all these IOU arrangements. So the big tech platform, the more efficient one, will be the natural provider of the currency ledger and the fintech arrangement. And the platform 2 just pays a fee to be part of it. So let me conclude and come back to my initial questions. Platforms control in our world is increasingly trading technologies, and also there are centralized record-keeping devices, so ledger operators. So what we argue is that can platforms set up a system of uncollateralized IOUs, and are they particularly good at it? We would say yes, because you really need a combination of the two. Just an independent ledger operator doesn't do the trick. So you need the combination of the two. The payments through the ledger are automatically used to settle IOUs. That's what I mentioned. You sell something, you sell the output good, and as the payment happens automatically, the IOU the money is withdrawn and settled with your liabilities or IOUs. So the right payment technology can collateralize, I should do this in hyphens, digital collateralized sales revenue. And what's very important is the platform can threaten to exclude you from the payments and also from the trading activities. Will private platforms want to do that? To set up these additional lending arrangements on top of their trading activities? And I said, you saw it from the value function. So it depends on the elasticity of substitution. So if the elasticity of substitution is sufficiently high, then actually the value function becomes negative, then I don't want to do it anymore. So they need enough monopoly power, people have to be enough locked in order to do that. Can big tech crowd out private cash trades? And this I just mentioned in the end. Yes, so big tech can crowd out the private cash trades as well. So it prevents tokens can actually take over. It's like a dollarization. Typically, we talk about dollarization when the dollar takes over at the global level. Here, it would be the tokens of a big tech company essentially taking over and crowding out the dollar. And what are the policymakers' concerns? Of course, we saw it by the value function. If the elasticity of substitution is very low, the platform can extract a lot of rents. Ideally, you want to just push the elasticity of substitution. We can vary that to a way where the value function is close to 0 but not negative. And then I mentioned at the end, and I couldn't go into the details, if the government says, okay, I would like to set up a ledger and everything, where you can link all your activities to this particular ledger, and you cannot default on it, then actually private platforms might have incentives to set up the black market on the side, which then can, accept it, defaulted agents. So it's okay, if you default on it, you can come to us and we will help you out to make still some trading activities. Sorry for being rather fast at the end. Thank you.
That's correct. Look, interesting. If you apply that model back into the lessons, the model to theory of the opening, something like stable points, which I think you have lateral lines, higher to sometimes.
Yeah, so
Does the model have anything to say about Ethereum or?
So Ethereum, so our model would say Ethereum would not be the ideal ledger operator because it doesn't have this additional power, yes, like what Amazon or Alibaba would have. So if they were competing with each other, Ethereum would lose out. Okay. Yeah, so that's the main message. The second.
Is fiat money also an unbacked?
So here so here it's IOUs which form our money.
Right.
So you issue something, and of course there's potentially defaultable debt, but I have to make sure that you don't want to default. Then it's actually backed by the credit. That gives you the default. Yes, and you could argue that the government money, the dollars here, was unbacked. It was just provided by the government.
Something like in practice, finance and it looks like unbacked ledgers, something that collateralized could be.
It's the stable coins.
On these open ledgers. So it almost seems like that's in practice.
Yeah, so that's a little bit like, I would say the stable coins would be almost like government money. Yeah. Because let's suppose if the stable coin is 100% backed with US treasuries or something like that, then it's like the government money here.
Yeah.
But if you want to get the private credit going, essentially say, can I use this private credit as a money? That would be the IOUs. Yes. Thanks.
Thank you, speaker again.
Thank you.